Earlier on in our session, we spoke about one statement and one question. The statement dealt with the relationship between optionality, convexity, and volatility, and the question asked about the fate of the risk manager who was responsible for generating the distribution of credit portfolio that we started this course with. It's time that we look at the answers. While we spent a fair bit of time on volatility, we still have to define convexity and optionality. If you take a look at the chart in front of you, what you have is the price yield relationship with respect to a bond, and the way it's displayed is that on the horizontal axis you have interest rates going from 0.5% to 19.5%. On the vertical axis you have prices going from 65 to 155. The price of the four bonds are price of three bonds are plotted on the chart. The purple line displays the 5-year bond, the green line the 3-year bond, and the maroonish reddish line the 1-year bond. The stake in the center, the yellow stake in the center, or the bar in the center, is at or about the point where the two bonds intersect. So the 3-year bond and the 5-year bond, the 3-year bond, the 5-year bond and the 1-year bond intersect, and you can easily drop another stake where the 3-year bond and the 1-year bond intersect. So my first question would be that what can this graph teach us about the price yield relationship? And there is an obvious trend here that you can see that there is an inverse relationship. As rates rise, prices fall. As rates decline, prices rise. But beyond that, what else can we learn? One question that we can ask is how would prices change if interest rates moved, and how would that change vary across the three bonds? So what I've just done is I've dropped a line that cuts across the three bonds at the level of 3.5%, just above 3.5%, and at 3.5%, the 5-year bond is priced at 135. The 3-year bond, the green line, is priced at it's about 118, 119, and the 1-year bond is priced at 106. Now, if prices jump from the 3.5% to just over 15.5%, a slide of over 12%. Sorry, if rates jump from 3.5% to 15.5%, a jump of over 12.5%. What kind of a price change should we expect? Once again, if we look at the line or the bar that I just dropped, the 5-year bond slides all the way from 135 to 85, so a loss of about 50 points. The green line or the 3-year bond slides from 118, 119 all the way down to 88, 89. And the 1-year bond slides from 106, 107 to about 95. So you can clearly see that for the same change in rates, the three bonds react very, very differently to price change. This sensitivity, this reaction to interest rate can be measured using an approximation or a tool called duration. While duration has many names, for the purpose of this course, the primary definition that we are interested in is the sensitivity of a bond to changes in interest rates, or the change in the price of a bond due to a change in the underlying interest rate. So how would you go about estimating this? I've just zoomed in to the yellow stake or the yellow bar in the middle, and you can see that for short durations of time, the lines are actually linear. While the slope differs for the 1-year bond, the 3-year bond, and the 5-year bond, but for small periods of time, so let's say if you stayed between 10.5% to 12.5%, for all practical purposes, you are looking at a straight line. There is no curve. There is a slope which indicates a tilt of the line, but there is no curve. So one way of estimating price change is to start with one of the oldest tools that we worked with in grade school math, and that is dropping a tangent. If I want to estimate the price of a 5-year bond or the rate of change in the price of the 5-year bond on account of interest rate movements, I can simply drop a tangent. Yeah, there you go. And that tangent basically touches the price curve at one specific point. I can draw a line or drop a line from a point where the two lines touch to find out the interest rate, which is, let's say, about 10%, as well as the price, which is, let's say, about 105 or just under 105, right? Now the question that comes up is that for about 9% to, let's say, about 11%, this tangent, this line, this approximation would work. But the minute you jump from 9% to, let's say, 1%, or from 9% to 19%, you can clearly see that the line that we're projecting to estimate the price change is very, very different from the actual underlying price. Now, the reason for this is that the estimate that we've calculated using this tangent, it's the same thing that we called duration earlier on, is a linear estimate. It's a first order estimate. The curve, on the other hand, is not a linear line. It's actually a second, third, fourth, fifth order line. Since it's a 5-year bond, I'd actually say that this is an equation, it's an equation with 5 roots. So the tool that we use to offset this error, the correction that we have to use side by side with duration, is called convexity. One way of looking at convexity is that it's a second order term that we can use to estimate the change in the price of the bond. Another way of looking at convexity is that if you look, I think the 5-year curve is actually a lot more convex than the 3-year curve, and the 3-year curve is more convex than the 1-year curve. The 1-year curve, for all practical purposes, looks like a straight line. The 3-year curve also looks like a straight line, but it's slightly more curvy, and the 5-year curve is the most curvy of the three. So if I translate what I've just done graphically into numbers, what I'm really trying to estimate is the change in price for a given change in interest rates. For duration's purposes, I want to calculate this change in price on a relative basis. And the formula that you see in front of you is basically P new minus P old, the new price minus the old price, divided by the old price, which gives us the relative change. And we divide the entire thing by the change in interest rate or change in yield, which gives us the unit change for a unit change in interest rates. The definition for convexity is a little more involved, because you're now trying to estimate a second order change, or for lack of a better word, you're saying what I'm really interested in is the rate of change in duration for a change in the underlying interest rate. As if you take a step back, what you're saying is duration is an estimate for the change in price based on the change in the underlying interest rates. Convexity is an estimate for the rate of change of duration for a change in interest rates, and hence the concept of first order for duration and second order for convexity. Now, to make things interesting, what I've done is I've replaced the 5-year bond, the 3-year bond, and the 1-year bond with two very different bonds. The blue line that you see that says perp is basically a perpetuity, which is an instrument that pays interest till the end of time. So there is no redemption of principal, but at the predefined interval you keep on getting the coupon that the perpetuity is supposed to pay. The 30-year bond, on the other hand, is known as a long bond. It's the bond that has a maturity of 30 years. For 30 years, on a semi-annual basis, it pays you a coupon, just like a perpetuity. However, at the end of 30 years, you get your principal back. So we have these two bonds in front of us, and what we're trying to do here is trying to just see how much prices move around as interest rates shift from, let's say, 7.5% to about 11.5% on the upside, and again 7.5% to about, I think it's about 4.5% or 3.5% on the other side. So move about 4% each way. So the question that we're trying to ask ourselves, and the answer that we're looking for, is if rates go from 7.5% to 11.5%, what is the expected decline in prices? And if they go from 7.5% to 3.5%, what's the expected upside in prices? And hopefully, when we see the answer to these questions, we will have an alternate definition of convexity, a definition which is very different from the view of convexity as only or primarily as an error term. Now, to make things easier and to save us a lot of trouble, I took the time out to actually calculate the prices for the bonds at these rate levels. So if you see here in front of you, you can see that at, let me see, 7.5%. At 7.5%, the perpetuity is priced at 71. Yes. And the 30-year bond is priced at 147. It's almost double the amount. Now, the question that you have to ask yourself is that if rates go from 71%, rates go from 7.5% to, let's say, 11.5%, how much would prices decline? And if you calculate this change for the two bonds, for the perpetuity and the 30-year bond, you can clearly see that for a 4% change in rates from 7.5% to 11.5%, the perpetuity falls from 71 to 45, a loss of about 26 points. The 30-year bond, on the other hand, falls from 147 to about 107, a loss of about 40 points. Similarly, if you look at the increase or the change in price when rates decline and go all the way from 7.5% to 3%, you can see that the perpetuity goes from 71 to 200, which is an increase of about 129 points, whereas the 30-year bond goes from 147 to 234, which is an increase of about 90 points. And hence, here is the alternate definition of convexity. And the alternate definition is, you can clearly see that the perpetuity is a lot more convex than the 30-year bond. And hence, the perpetuity, because of this added convexity, tends to rise more or rise by more when interest rates decline and fall by less when they rise. This is our alternate definition of convexity. Convexity is that property of an asset that allows it to fall by less when interest rates rise and rise by more when interest rates fall. Just to put back in context, here's the graph again, but this time we've put in the 30-year bond, the perpetuity, side by side with the 5-year bond, the 3-year bond, and the 1-year bond. And you can clearly see that while the 1 year is more or less a straight line, a linear line, and the 5-year is certainly a little bit more convex than the 1-year bond, but when it comes to the perpetuity and when it comes to the 30-year bond, they are certainly a lot more convex than the other. So now that we've looked at convexity, let's see how we can relate convexity with options and optionality. What you see in front of you is a payoff profile for a put contract. A put gives its owner the right to sell a security at a future date at a price that has been agreed upon today. So as prices fall from 75 to 45, you can see that the put is a straight line, which is basically the premium or the cost of the put that has been borne by its owner. And once they fall beneath what's called a strike, the price at which the security will exchange ownership, once prices fall beneath that point, the put starts to get into the money. Right? Now, I don't know if you can see this, but if you take a look at this slide, the next slide, do you see what I see? You have a convex curve. The payoff profile that you see is an exact payoff profile. In reality, premium and prices for put contracts tend to stay just above the line because of the element of what you call intrinsic value. Now, if I were to take this convexity and relate it to this convexity, my primary reaction is that yes, I have a convex curve, but what's the great deal? What's the big deal? What is the relationship with volatility? the slide that you see next basically plots the value of a call and a put contract against volatility. So if the baseline price at 5% volatility is about 10 cents, by the time that volatility goes to, let's say, 20% from 5%, so a 4-time increase in vol, the price that was trading at about 5 cents is now trading at about just about 40 cents, right? So the increase is not 4 times, it's actually 8 times. And as you go from 5 to, let's say, 75, which is an increase of let's say 25 times, price goes from a couple of cents to about 1.2 to $1.4, which is a fairly significant increase. So the point that I'm trying to make here is that options become more valuable with increased volatility. A put contract at lower volatility levels is cheaper, or a lot more um, uh, is a lot less expensive compared to the same put contract at higher volatility level. And the relationship that we spoke about earlier is exactly the same relationship. There is a very strong connection between convexity or convexity rich assets such as long-term bonds, long bonds, perpetuities, as well as put and option contracts. And this relationship is further strengthened or becomes even more interesting when we factor in the impact of volatility on the value of these contracts. If you go back to this curve where you're looking at the change in price, you can see that with added convexity, the ability of a bond to rise by more and fall by less increases dramatically. If I were to add to the same list the prices and the price changes for the 5-year bond, the 3-year bond, and the 1-year bond, you'll see that there is a dramatic difference in how much prices move for a perpetuity for, let's say, an increase or decrease in interest rates compared to, let's say, the 1-year bond, right? We're saying the same convexity is also applicable to the put contract because the underlying shape is exactly the same. And it gets even much more interesting when you add in the impact or factor in the impact of volatility to this mix. So that's the first statement, the statement where we spoke about the fact that we believe that there is a very strong relationship between optionality, convexity, and volatility. So onward to the fate of the risk manager. We started this session with a quick look at the distribution of credit of a given credit portfolio across rating scales, and we said that in the beginning that there is clearly a very significant skew towards rating grades 1 to 4 or 1 to 5 compared to the other. Then we asked ourselves that if we were looking at this as the distribution of a credit portfolio, what would be our assessment of the effectiveness of the credit manager or the underlying credit process? So, clear indication of skewness, and here we're saying that there is a small chance or a reasonable chance that we are actually not seeing a skewed distribution. What we're seeing is more along, if we had more data and more points, possibly a normal distribution. So skewness, normal, skewness. What does that tell us about the underlying credit process? The question that I ask myself when I see results like these is, if I look at this distribution, if I were to toss a coin, if I were to flip a coin and use that coin to decide whether to lend or not lend money to a client, if I were to use a coin as my primary credit assessment process, I'm reasonably sure that the underlying distribution that I would generate would be along the lines of what I see here in front of me. Which then raises a very interesting question that, can I really replace my credit manager in this specific case with the toss of a coin? My answer would possibly be yes. Now, if you think that this is extending things a bit too far, remember, a coin toss generates the binomial distribution. Over 30 tosses, the binomial distribution, or when n crosses 30, the binomial distribution tends to converge to the normal distribution. What you see in front of you is a normally distributed result, which indicates that the underlying process is either binomial or normal in nature, and hence the assertion that what you're really looking at is the coin toss. There is no additional incremental effectiveness added by the role of the credit manager in this case. If there was, the curve that you would see would be along these lines. Now you can make a case that the reason why we're seeing this is possibly because um, there is, from a credit policy point of view, the bank in question is focusing specifically on the tiers rating from or going from 33 to 67 or 65. However, I would counter that by saying that even if that was the case, you would see a much more intense clustering than the one that you see here in front of you right. So the next question that comes up is, all right, even if this is the case, why do we care? Besides the efficacy of the credit function, is there anything more to it? And I would just leave you with one thought, which sort of links both the statement and the answer and the question that we proposed earlier at the start of this course. Think of debt as a put contract. Think of debt as a put contract with an embedded element of convexity attached to it. Then factor in the impact of the optionality built in a debt contract. Think and factor in the element of volatility with respect to the environment around you as well as the nature of the debt contract. And then try and link the last 5 to 10 minutes of this lesson together and decide whether this question of effectiveness with respect to the efficacy of the credit function is an important question or not, and whether you should retain the credit manager, give him a bonus, or fire him. So this ends the answers section of part 1 of the quant crash course. I hope that after the review of volatility, after the linkage between optionality, volatility, and convexity, and the question and the answer about the fate of the risk manager, you have some interesting questions to ponder on. I will hopefully see you next in part 2 of our course, where we move on to the concept of value at risk, capital, and limit allocation. This is Jawad Ahmed Fareed for FinanceTrainingCourse.com. Thank you very much for your time. This video has been brought to you by FinanceTrainingCourse.com. For a number of additional similar courses, training materials in PDF file format, sample Excel files, and models, please see FinanceTrainingCourse.com. Thank you.